Hi, and welcome to Janken's Guide on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to talk about how to construct measures of downside risk and how to use them to support a risk management program at the strategic level. And for more on managing downside risk, please consult my book, Empowered Enterprise Risk Management, co-authored with Petter Kapstad. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. All right, so what are we looking at here? Apparently, after a long period of calm, something happens. And indeed, it does. What we're seeing is the probability of not meeting commitments. It's a risk measure we developed in a firm I was working with some time ago. And the result of this spike in risk was the fact that there were several changes taking place. One group in the company were promoting an increase in the investment budget. Another group wanted to see an extra dividend paid out. At the same time, the main product prices of this firm were falling. And these three things combined to produce this sharp increase in risk. And the company was able to see this because they had an integrated risk model that provided this feedback, and they subsequently went back and fine-tuned the policies so as to come out of this with a risk profile that they were more comfortable. So that is an example of how you can be informed by measures of downside risk. But let's get the record straight here. We're not here to obsess about downside risk exclusively. We're ultimately interested in upside potential, pursuing business opportunities and creating value. We're only interested in quantitative measures of downside risk insofar they help us do that. So that's the perspective taken here. So there are two important uses then of such measures of downside risk. One is that you can get immediate feedback from your risk model what the risk return impact is from this policy. So you can proactively evaluate the policy, and these risk measures will indicate to you what happens with the risk profile if you choose to implement this particular policy that you're looking at. The other then is what we've just seen, that you follow it over time, and these changes can be very informative and draw your attention to where it's needed and generate good discussions. So following risk over time in a consistent way and getting informed about what drives these changes in risk, that can be very useful as well. And how then can we set up or create a measure of downside risk that we would find attractive and useful? Well, first of all, I'd say that we have to align it with how we intuitively think about risk. It has to capture a dimension of risk that we find relevant. And that is largely about thinking of risk in terms of the possibility of something negative. I mean, this is how most people relate to risk, right? It's something negative in the sense of harm, losses, failures, damage, etc. And so what if our risk measure can capture something that is undeniably negative, something that we would like to avoid and prefer not to happen? The other thing is that since we're actually here on behalf of somebody else, the shareholders who run the company, we're supposed to be able to argue that risk management, as any other major corporate activities, creates value at the end of the day. And how can we argue then that this risk measure captures a risk that is ultimately of interest to these shareholders, that we're not indulging in personal risk preferences here? It's actually capturing something that is of relevance to the value creation process. And therefore, we're going to propose to think of risk in terms of reaching critical threshold levels of performance, so that if performance goes below these thresholds, you're in for some negative consequences that would trigger a negative consequence of some sort here and disrupt the value creation process. Like you're not able to invest, for example. Let's say you have insufficient funding for your investment because performance fell below some threshold level. That's a negative consequence with value implications. So we want something that is supported by theory. The theories for how risk management can create value. That should also inform the design of our risk measures. So here we have a possible measure of risk that has been or is widely used in financial theory. It's the standard deviation. It's a proxy for risk in some applications. It tells you how spread out your outcome distribution is around the forecasted mean. And but the thing here is that it's symmetric. You can see that it's spread out on both sides here, and you have 68% of observations within one standard deviation here, on both equally dispersed on both sides of the mean. So it's symmetric. Whereas our intuitive understanding of risk is not symmetric. I mean, we want upside potential, and we're going to see them in relation to each other. But our understanding of risk is that it's on the downside. So this is a measure of dispersion, not necessarily risk. I mean, many times it will convey the same information as a risk measure targeting downside, but it's not always so. And we might do better, I think, if we can then align with our intuition and set up risk measures that target the downside exclusively, which is in this case on this side of the mean. Like here in the tail of the distribution, most likely we find real risk, something that could be very unpleasant and damaging for the company. And all simulations in this video are done using @risk. It's an Excel add-in for simulating risk in spreadsheet models. So what have we then that can help us move beyond the standard deviation? Well, there's something called the lower partial moments framework, which is basically all about constructing measures of downside risk. So it targets some tail of the distribution where we can agree that, okay, this is real risk. This is highly undesired outcome that we would like to sort of watch out against and maybe manage with reference to that target level, right? So you're going to have to choose or select 3 parameters. Actually, it's 2 parameters and a variable, but never mind that. And here we have lots of possibilities to achieve what we said we wanted to achieve, which is to align with our intuition and theories for value creation, because we can choose these parameters in such a way that this is accomplished. And so that's our goal here. So this is what it looks like, and maybe it's a little bit terrifying to see like that, but it's not so bad. It's really just 3 parameters here then that we're going to discuss. One is the threshold of performance. And the thing is that going below this threshold would be really bad. In other contexts, it could be about going above a certain level. I mean, this was developed in the context of portfolio theory and financial investments. So it's always, risk is always on the downside, but depending on your variable and your setting, it could be the upper partial moments as well that are relevant. Anyway, you have to identify a threshold that would inflict some pain on the organization if not met. If you don't reach it, it's bad. There are going to be consequences. The other thing you have to settle for is some measure of corporate performance that you're going to think is relevant. I mean, there are plenty, right? Cash flow, net income, financial ratios, all sorts of performance variables that we do care about. But here we're talking about you have to select one of them and create your measure with reference to that variable performance measure. So K here, over here is the penalty applied on shortfall. So whenever a shortfall occurs, meaning that the performance is below the threshold, that's the meaning of this conditional statement here, that risk is only when we fail to meet the threshold level. All other outcomes are considered non-risk, right? So it only contributes towards risk if it's below the threshold. If below the threshold, then you take the difference between the performance number and the threshold, which is going to be a negative number then, and you raise it by the power of K. So K is a way for you to put a penalty on these shortfalls. The worse you think it gets, then you apply a larger penalty. So if shortfalls are progressively worse for the organization, K should be above 1, etc. And we'll come back to how to actually do that. But these 3 parameters you can use, or you use them in such a way to design a measure of downside risk that is relevant to your organization. It can be attuned to these theories of value creation, and it's because it targets downside risk, it's already aligned with our intuition, right? That risk is something negative. It's about shortfalls. So here's the continuous version of this measure, where you're looking at probability mass up to the threshold T. So meaning that risk, it will contribute towards risk in between the negative perpetuity and the T, up to the threshold. That is the risky part of the outcome distribution. And same thing here then, when you are below the target, the threshold level, well, you penalize that shortfall with this parameter K here. So X is the performance variable. This is the function describing the stochastic process of X. And in some proportion of the outcome distribution, it will be falling below the threshold, or it could at least. So we have dealing with a stochastic process here for performance, and we're deciding which threshold level we are measuring risk relative to. So again, as before, only shortfall's relative threshold is risk, and you apply a penalty to the shortfall. All right. So by selecting K, you then determine the penalty you apply to each shortfall. So it's been called the risk aversion coefficient. It means that the more risk averse you are, the more you hate risk or suffer from it, you would penalize it more by raising this parameter. So if you set it to 0, then you apply no penalty, essentially, and the measure will return the probability of going below that threshold level. So it doesn't distinguish between large and small shortfalls. It's just the probability of ending up below it. With 1, you do raise it by the power of 1 then, so that you care about the size of the shortfall. You probability weight essentially the shortfall. Whenever K goes above 1, you have a situation where you apply progressively larger penalties the more or the larger the shortfalls get, so that you're saying that a large shortfall is disproportionately worse than a small shortfall relative to the threshold. So take an example here. Cash is our performance measure now, so we're going to be interested in the risk related to our cash position. And maybe risk to us is running out of cash. If T is 0, it means we hit it's empty, empty bank account. We're in trouble. So when you reach that point, you're out of cash, and you're going to start doing some drastic things that you would like to avoid, right? So risk is running out of cash, and you have now put this into practice, the LPM framework. That was all it took. So now we just have to settle for the K. What's the penalty going to be then? But to implement this in a spreadsheet, we are going to first come up with an outcome distribution. So these are values, potential values for cash. So I've just assumed some numbers here. This is a hypothetical distribution. Each potential outcome comes with a probability. So you see that the probability mass is concentrated here around the expected outcomes, but there's some probability that you will end up in one of the tails, right? So this is a kind of a bell-shaped type distribution for cash, which is our performance measure. So we see here that if the threshold is 0, then we have 3 outcomes that go below 0. So these will count towards risk because they represent shortfalls. Everything else is set to 0 because it's not meaningful from a risk point of view. We're fine. We're managing to meet the threshold. And then you have the shortfall then, and the question is, to what extent are you going to penalize it? So we set 3 different values for K here. And if it's 0, to take that first, we don't apply a penalty. We just register that a shortfall has occurred. If you raise something by the power of 0, it returns a 1 here. So no matter the size of the shortfall, you always get 1 when you raise it to this power. So that's really all that happens. There's no penalty involved. You don't care if it's a large or small shortfall. The fact that it is a shortfall is the only thing that you're interested in with that. And then what happens then to get the actual risk measure, the below target probability, you sum up the probability of all these shortfall scenarios. So you have the probability given over here, right? And we're saying that, okay, yeah, these are risk, these outcomes are risk. And therefore, we are going to sum up the various possible probabilities of them happening. If you do that, it's a 9% probability of ending up below the shortfall, but no penalty applied to the outcome, right? So, all right. But what about impact then? We've discussed in other tutorials that a complete measure of risk is probability times impact. You can't ignore the likelihood aspect of a risky event, nor can you ignore the magnitude, because a larger impact, negative impact, is usually going to be worse, you know. So, and by setting k equal to 1, we align with this definition or this intuition that the magnitude of the consequence matters. So now k is 1. And raising the shortfall by a power of 1 returns the shortfall. Mathematically speaking, that's what happens. Whenever something is raised by a power of 1, you get the number itself. All right. And then we proceed to do the same kind of probability weighting as before. So we take each probability times each shortfall, right? So by doing that and summing them up, we get below target risk. So the probability weighted shortfall, the expected shortfall in the terminology, is -4. If you take each shortfall here and weight by its respective probability, you get this number after summing. All right, so now we've managed to incorporate the fact that the magnitude matters, right? We're not indifferent to very large shortfalls versus merely large shortfalls or something like that. So, but then we also have this idea then that what if large shortfalls are disproportionately worse than a small one? So we would like to impose a penalty on the really big ones, because that's on the argument that that is where the really terrible stuff goes on, you know, that it gets disastrous. You know, you can probably survive a small shortfall, but if it gets large enough, you're in for some serious trouble, right? So on that logic, you would perhaps want to apply a larger penalty, the larger the shortfall. And that's what you do with by setting k larger than 1. So let's take k equals 2 here. In this case, we're working always with the same shortfall, right? The question is only a matter of how do you penalize it. And here with k equals 2, what happens is that you square it, and then it turns into a positive number again, as per, you know, the mathematics of this. It also becomes a very much, you know, very clearly a larger number here. And you see that for these relatively small shortfalls, the pain the negative consequence imposed on the organization is bad, but it's not super bad. Whereas here it gets a much larger number and this grows disproportionately. So consistent with the logic then that you really, this is really, really bad. Like this could kill you, whereas this will just hurt. So this way of penalizing the shortfalls capture that idea, right? So when you probability weights, you get a bigger addition to the risk measure from the very large shortfalls, despite the lower probability of happening. So again, it's a matter of probability weighting, right? And we call this a semi-variance because it's a variance computed only on the outcomes below the threshold. Same idea, probability weighting these outcomes. All right, let's see if we can use this. That was the sort of idea behind it all. Let's see if we can apply it. So we now have a setting where EBIT is, we've chosen another performance measure now. EBIT, earnings before interest and taxes. T is 200. These are just made up numbers. And we're going to apply no penalty to the shortfalls. The forecasted number is 500. So the worry is that we're falling below the threshold T here, 200 million, maybe because we need that kind of money to be able to invest, or for some reason we need that liquidity. If it were to go below that, it would mean some consequence that we would like to avoid, right? And the standard deviation in this forecast is 500 based maybe on historical numbers. We've seen that EBIT tends to move around by that much historically. So we set it up in Excel here. We're using a risk function to generate random numbers. So it takes the forecast here. There it is, 500. But it attaches a standard deviation, a measure of the uncertainty around that forecast. So it's 30%, right? But that 30% should be understood in relation to the forecast. So you multiply it. Now we will draw random numbers for this variable, the performance variable. We will not, as before, just get the point forecast. We now have a distribution simulated around it based on this standard deviation number here. The shortfall we can capture in the spreadsheet by just having it using the if statement here. Check. It needs to check then if EBIT is below the threshold, then risk. You know, that's the condition here where we're considering something risk. You know, we failed to reach the target. So okay, if below threshold, then compute the shortfall. If whenever it's above the threshold, we're fine. That's not risk. It's not going to impact this risk measure. So that's a zero then. You know, it's and then we do implement the LPM here, so that if you have a shortfall above zero or equal to zero, rather, it's going to be zero. That's just to get rid of nonsensical outcomes. But the important thing is here, the shortfall is raised by the power of k. So we implement the formula now this way. So it's just a simple matter of writing the shortfall into this cell and raising it. So it links up to here, right? In this case, it's a zero. So there won't be any penalty applied. We'll just register if there's a shortfall. It's flag a 1 essentially. So if we do that, again, we can have the at risk deliver the risk measure in the spreadsheet directly. We do that using the risk mean function and refer back to the LPM measure we calculated here. So based on this kind of randomness in performance, we have this probability of falling below the threshold. So if you were to start simulating, you would see that in the simulations, right? So for example, here, that we've simulated the EBIT, and we have the distribution of outcomes. 500 is the forecast. So the distribution will be centered around that. Here then, if you look at this line, it's 200. It's a threshold. So the probability of not meeting or reaching this threshold is found to the left of this line. And as you can see here, it's 2.3%, which is exactly what we're seeing here, that the probability of going even further out in the tail here is 2.3, right? So if we do this, so that's the basics of it. You can now implement it in a spreadsheet. All it takes is an underlying outcome distribution on which to apply these risk statistics. So you can do that for many different performance measures. Now you're not limited to one by any means. You can here's the one we just did. Now we're adding cash, running out of cash, and here there's a penalty because to signal that we do care about the magnitude of the shortfall. FFO to debt could be relevant because we're managing some rating or some loan covenant, and maybe this threshold here is connected to one of those. So really bad if that is breached. No penalty applied. I mean, you can vary this according to your thinking on the subject and what's meaningful in that context, and then derive risk measures for all of them, and together you now have a sort of take on your risk profile. multiple risk measures of this sort together, they describe, you get a handle on your risk profile, right? And then you can use that. Earlier we saw how risk trends over time, and you can get informed about that, the fact that something is going on, and maybe you should be doing something about that. Here we're using it a little bit differently, where we have a current risk profile on the current set of policies. This would be the risk profile. 8% risk of going below this measure. This is the expected shortfall for cash. This is the risk attached to the FFO to debt measure. All right, that's what we have. Let's say we implement in our risk model now another policy or proposal here to finance some extra growth using debt. Okay, that's going to be risky. So all the indicators are up now. You're seeing a fairly meaningful shift in the risk profile. So maybe you want to think twice. Okay, are we fine with this? Is this really worth the while here now, that given the risk consequence? So it gives food for a discussion, right? I mean, there's no automatic conclusions to jump from this, except that you now have the possibility to evaluate what would happen to your risk profile, and if that is prudent, and if it's still value creating. Maybe the strategy is so promising that you want to do this anyway. I mean, it's not the case that we're going to be turning down risk at every chance here. It's more a case of evaluating. Okay, this obviously means more risk. Are we fine with that? And to compare these different measures, then, I mean, we find that these probability measures are more intuitive. It's very easy to see what they're trying to do and relate to them. Expected shortfalls are less intuitive. It's a dollar number or a euro number, depending on your base currency. But it is theoretically more correct, right? I mean, it's probability times impact. Somewhere, you know, the magnitude ought to matter, and we neglect that dimension at our own peril. I mean, we do care about, especially when you incorporate some tail risks, you know, then the tail outcomes are going to be of quite some interest, and you shouldn't just ignore that through using some probability of measure. Then these semi-variances are more opaque, you know, and less works less well for communicating risk. They're good though, in the sense that they are aligned with the theory of it all, that it is justified in many cases to argue that it gets progressively worse the larger the shortfall is. There's not a linear sort of development in the cost of risk here. So, but yeah, maybe you want to, instead of doing that, use multiple thresholds to capture the fact that, okay, you're approaching some very dangerous territory. So as an alternative to using these semi-variances, which people are unlikely to sort of wrap their heads around for the most part. So I mean, you can fine-tune your risk profile instead by adding more threshold levels, one that is critical. Like it's obvious that this would be disastrous for the organization, so you don't need to apply any penalty to it. It's just the fact that it happens says it all, you know. Whereas you have, for the same performance measure, you then have different thresholds. So that's a way to sort of approach this issue with the tail risk. Anyway, we have to remember, as always, to complement this with some black swan thinking, some credit scenarios, and stress testing. So I mean, just as a small reminder. Conclusions then, these measures of downside risk can help you manage your risk profile and safeguard the value creation process. Remember, we're interested in upside potential and all that, and value. Managing downside risk can help us do that. That's the premise. All right, the lower partial moments is a flexible framework for dealing with all this practically. It offers you great flexibility in designing a set of risk measures based on only 3 parameters. You choose a performance variable, a threshold, and a certain penalty. And those can be varied, you know, in a very flexible way. And these downside risk measures are particularly informative when followed over time to see trends in risk, and when you compare them to proactively evaluate different strategies. All right, that was it for today. Please check out my books, my webpage, and please like and subscribe, and have a good day.